Hi there and welcome to Money Managers, a User's Guide. I'm Nathan Peters. Before we start, I'd like to echo many market participants' expressions of grief at the recent loss of David Swenson, CIO of Yale University's endowment and a true titan of our industry. Pretty much everyone on the buy side today is operating within the disciplines that Mr. Swenson created across multiple asset classes, whether we know it or not. I can't think of anyone more influential in the investing world. In fact, I can't think of anyone who better lived our mantra here. David Swenson used his money managers to achieve Yale's goals to spectacular effect. Today, I'd like to highlight another of our titans of UK money management, Nick Train of Lindsell, a manager of multiple funds and trusts, but we'll be discussing the flagship Lindsell UK Equity Fund, ticker LTUKEQA. This is a direct request from viewer Royal King, and a good one it was. Indeed, thanks Royal King. For those who don't know who this manager is, Nick Train is coming up on a 40-year career, 20 of which has been at his eponymous firm. In a nutshell, Lindsell Train aims to invest in rare and exceptional assets and franchises difficult for others to replicate. He also claims to never sell once they've been identified in order to allow the wonder of compounding to work its magic. The results on the Hargreaves Lansdowne website are here, and they are certainly magical. Now, there are similarities here with the prior fund review we did for Fundsmith Equity, link in the description below. Both funds are concentrated long-only equity stock picking funds. Both exhibit about a third of the risk coming from idiosyncratic stock picking, which is high for this strategy, and both have made good money for investors by doing that and easily covered their fees. So far, so good. I'll come to Venn to compare them directly here, Lindsell Train versus Fundsmith Equity. Here are the returns and risks and Sharpe ratios and drawdowns. Lindsell Train also has a greater focus on UK stocks here, a 0.2 beta to small caps versus none for Fundsmith, less of a quality and foreign exchange risk than Fundsmith, and a higher sensitivity to the equity risk premium more generally here. Key here, though, when we discuss the risk profile of these funds is that both funds are anti-value funds. And Nick Train was quite open about this when talking about his sell discipline in a recent fund update I'll play for you now on YouTube.
Next one's quite an interesting one. To what extent does extremely high short-term valuation lead you to consider selling or reducing a holding? I think that's a good one, Nick.
Well, we are the effect that we have captured to date, and I sincerely hope we can continue to capture into the future. The effect that we're seeking to capture is running winners. And if that is your chosen approach, then you have to acknowledge that there will be periods when a security that you own may get somewhat overvalued, may go through a period of underperformance as a result. But to us, it's worth living through such episodes in order to capture the full effects of the long-term compounding. So it would be less to do with valuation and more to do with a conception that a company that had reached the end of its strategic optionality.
So longtime viewers will know I'm not going to let this nugget go. The effect that Nick Train is capturing has had very large drawdowns in the past, just not during his fund's track record. Sure, he was down minus 40% in the great financial crisis, but the index was worse, down about 45%. If we take a look at Venn, however, and cast our data back to the year 2000, a rather different narrative appears, one in which buying stocks and not selling, even though you know they're expensive relative to their industry and their own history, led to rather worse relative outcomes. With today's factor exposures in the Lindsell Train UK Equity Fund, our best guess is that you would have lost 76%, with a confidence interval around it of about plus or minus 52%. So yes, zero value is in that confidence interval, while the FTSE 100 would have been down about 38%, with a plus or minus 16% confidence interval. The alpha that Nick Train is renowned for generating wouldn't have helped out the fund that much. And the anti-value factor exposure just decimates the fund, accounting for 178% of the expected drawdown. Now, I don't think clients would be as forgiving about Nick Train's never sell discipline if they fully internalized the risks such an approach carries with it, latent though it appears to be. That's all I have for you today on Money Managers, a User's Guide. Thanks for watching, and let me know if you have any feedback by smashing that like button, commenting, sharing, and hitting the bell for notifications of future episodes. And remember, like David Swenson, use your money managers. Don't let them use you. Thanks. Bye.